Imagine making 1,000% returns on your investment in just 8 months. Your friends are getting rich. Your barber is getting rich. Even your maid is buying stocks. You mortgage your house, sell your jewelry, and throw everything you have into the hottest company in London. Then, in a single day, you lose it all. This isn't a story about crypto or GameStop. This happened 300 years ago, and it created the blueprint for every financial disaster that followed. Welcome back to Vaulted Wisdom. Today, we're diving into the South Sea bubble, the catastrophe that taught humanity its first brutal lesson about greed, manipulation, and the madness of crowds. It's 1719, London. Britain has just emerged from years of costly wars, and the government is drowning in debt. Enter the South Sea Company, a trading corporation with exclusive rights to trade with Spanish colonies in South America. But here's the thing, they barely traded anything. The Spanish were hostile. The routes were dangerous. The profits? Almost non-existent. Yet somehow, this company convinced the British government to let them take over the national debt. Think about that. A company that made virtually no money was about to become responsible for an entire nation's financial obligations. The plan was seductive in its simplicity. Investors would exchange their government bonds for South Sea Company stock. The company would pay the government's debts, and in return, they'd have a monopoly on trade with the wealthiest colonies in the New World. The directors painted pictures of ships returning laden with gold and silver. They whispered about untapped markets filled with eager customers. They spoke of profits so vast that shareholders would become the new aristocracy, and people believed them. What happened next was pure madness. The South Sea Company's stock price began to climb. £128 in January 1720, then £175, then £330. With each rise, more investors poured in, desperate not to miss out on the fortune everyone else seemed to be making. The directors weren't content with natural demand. They launched the most sophisticated manipulation scheme the world had ever seen. They offered loans to buyers. You could purchase stock with just a 10% down payment. They spread rumors of imminent trading agreements with Spain. Most deviously, they paid huge bribes to members of parliament, including the Chancellor of the Exchequer himself. But here's where it gets truly insane. The success of South Sea Company stock created a fever that spread far beyond one company. Suddenly, London was flooded with new companies offering shares to the public. The South Sea bubble spawned dozens of smaller bubbles. Companies promised to drain the Red Sea to recover treasures from Pharaoh's army. Others claimed they would extract silver from lead. One company, I'm not making this up, raised money for a company for carrying out an undertaking of great advantage, but nobody to know what it is. That last company raised £2,000 in a single day, about £400,000 in today's money, for a business that literally refused to explain what it did. By July 1720, South Sea Company stock had reached £1,000 per share, nearly 10 times its January price. Fortunes were made overnight. Dukes mortgaged their estates. Servants became stock speculators. The entire social order seemed to be transforming before everyone's eyes. But then reality came knocking. In August 1720, a few sharp investors began asking uncomfortable questions. Where were these massive trading profits? Why hadn't any ships returned with the promised treasures? What exactly was the South Sea Company doing with all this money? The smart money started selling. And once selling began, it became an avalanche. The stock price that had taken 8 months to climb from £128 to £1,000 collapsed to £175 in just 6 weeks. But it didn't stop there. By December, shares were worth less than £124, below where they'd started the year. Panic swept through London like wildfire. Investors who had borrowed to buy shares faced bankruptcy. The elaborate loan schemes that had fueled the bubble now accelerated the crash. As prices fell, lenders demanded more collateral. When investors couldn't provide it, they were forced to sell, driving prices down further. The Bank of England, which had initially competed with the South Sea Company, now found itself trying to prevent a complete collapse of the financial system. The aftermath was devastating. thousands of investors were ruined. The lucky ones lost their savings. The unlucky ones lost everything: their homes, their businesses, their social standing. Suicides were reported across London as prominent families faced complete ruin. The political scandal was just as severe. When investigators examined the South Sea Company's books, they discovered that over £500,000 in bribes had been paid to government officials. The Chancellor of the Exchequer was imprisoned in the Tower of London. Members of Parliament were expelled in disgrace. But perhaps most shocking of all was what they found in the company's actual business records. After years of promising vast trading profits, the South Sea Company had made exactly one voyage to South America during the entire bubble period. 1. The whole thing had been built on lies, manipulation, and the basic human psychology that drives people to believe what they desperately want to be true. Isaac Newton, one of the greatest minds in history, lost £20,000 in the crash, about £3 million today. His famous comment afterward: "I can calculate the motion of heavenly bodies, but not the madness of people." So what can we learn from history's first stock market crash? First, when everyone is getting rich quickly, be suspicious. Real wealth is rarely created overnight, and when it appears to be, someone is usually creating an illusion. Second, when companies make grand promises about future profits without demonstrating current results, run. The South Sea Company's business model was always, "Trust us, riches are coming." Sound familiar? Third, when borrowing becomes easy and speculation becomes socially acceptable, we're probably in a bubble. The South Sea bubble was fueled by debt and social pressure, both warning signs we've seen repeated in every major financial crisis since. But perhaps most importantly, the South Sea bubble revealed something uncomfortable about human nature. We desperately want to believe in get-rich-quick schemes. We're afraid of missing out on what everyone else seems to be gaining. And we're surprisingly willing to ignore obvious red flags when money is involved. These psychological weaknesses haven't changed in 300 years. They're the same forces that drove the Tulip Mania, the dot-com crash, the housing bubble, and yes, even the recent cryptocurrency frenzy. The South Sea bubble was just the beginning. Over the next 3 centuries, humanity would repeat this same pattern again and again, each time convinced that this time is different. Next week, we're traveling to Holland in the 1630s to explore an even stranger bubble, one where people paid more for a single flower bulb than most people earned a year. The Dutch Tulip Mania proves that bubbles can form around literally anything when human psychology takes control. Subscribe to Vaulted Wisdom and hit that notification bell so you don't miss it. And if this story reminded you of any recent investment crazes, let me know in the comments below. Until next time, remember, the greatest wisdom often comes from studying our greatest mistakes. Thanks for watching Vaulted Wisdom. If you enjoyed this deep dive into financial history, check out our playlist on great financial disasters. And remember to subscribe for more stories that connect the past to the present.